Hello and welcome to this YouTube channel for ACCA FI exam prep. My name is Adam. In this video, I'll be taking you through how to account for sale or return transaction where we have revenue to be recognized by applying the principles where there is a repurchase agreement in place in the transaction. Now let's look at the question. This is an extra from a past question. So let's look at the details. So we have an extra from the trial balance and the year end 30th June 2015. So we have revenue, cost of sales. The additional information, revenue includes 3 million. So this revenue includes 3 million sale made on 1st January 2015. So reconcile that to the year end. So we are looking at from January to June, that is 6 months. So we are looking at 6 months to year end. And these goods are maturing goods which are not biological assets. So a maturing goods can be wine, which will take time to mature. So the inventory can be sold on a sale or return or repurchase agreement. The carrying amount of these goods at the date of sale was 2 million. So again, it means that there is a profit of 1 million on the sale. Mostel is in possession of the goods, but they have not been included in the inventory count. So look at it. Mostel is a company selling a maturing inventory, and often these arrangements can be between the entity and their bank or another financing house. So here, Mostel sold these maturing goods for revenue of 3 million and is still keeping the goods or the inventory and has an unexpired option to repurchase them at any time in the next 3 years. So they can repurchase this maturing inventory, so they will buy back. In 3 years' time, the goods are expected to be worth 5 million. The repurchase price will be the original price plus an interest at 10% per annum from the date of sale to the date of repurchase. So what it means is that in accounting for revenue in the current year end, the substance of this transaction is that Mostel have gone for a loan and have used a maturing inventory as a security or as a collateral. So we say it's a secured loan. So the entity will have to account for a liability, which is the loan amount, and every year end they would have to account for interest on this loan. Again, it means that the inventory has not been sold, so they have not sold the goods, and these goods should be part of their inventory for the year and not included in revenue. So what we're going to do now is to pass the necessary adjustment. So the adjustment would be that we would debit revenue, and debiting revenue 3 million means that the revenue you see on the trial balance, which is 113,500, should be, we should deduct 3,000, which is 3 million from it, and we will credit the cost of sales. So we are removing it from cost of sales. Now, on the face of it, the cost in the cost of sales would be the 2 million. So it means that it was included in the cost of sales. So we have to take out these from the cost of sale. So it means that the value you have 88,500 minus 2,000, which is 2 million, should be taken from the value of cost of sale. In effect, what we have done again is to say that we are going to add back to inventory. So it means that we are adding back to inventory at year end. So we add back to inventory 2 million. It means that in a year end, inventory should have a value additional cost of 2 million. Is the reason why we are going to deduct from the cost of sale, because it is closing inventory. And you know how we calculate cost of sales: opening inventory, add purchases, less closing inventory, and deducting the closing inventory will be credit against the cost of sales. Now, the substance of it we have is that Mustang have gone for a loan, so we credit financial liability. So we'll call it loan, and that loan amount is 3 million. So you see that the double entry have cancelled out here. So now it means in the current year they will have to debit P&L with finance cost, which will be the interest on the 3 million. So it is 3 million times 10%, and 10% per annum. Remember, the transaction was on 1st of January 2015 to 30th June 2015, and it means that you're going to take only 6 months of the interest to P&L. So let's see, 3 million times 10%, that is 300, half of it, and that is 150. So the interest will be 150,000 to the P&L. So at the end, you see a total liability of 3 million. So 3 million plus the 0.15 million. So in effect, we have 3.15 million, which will be the total liability to be recognized. So look at it. This will be in the financial position. This will be in P&L. This adjustment would also be in P&L. And this will also be in the financial position. Remember, this is inventory, so it will be part of the current assets. And this will be part of non-current liability. Very straightforward. It's adjustment which we have to ensure we understand it so well for the purpose of the exam. So we need to understand clearly. And this is a single entity question. It's a single entity question, very straightforward. Repurchase agreement, or what you can call a sale or return agreement, or sometimes we refer to it as consignment inventory. Great. I hope this helps in your preparation for the FR exam. Please subscribe to this channel to receive updates on new videos.